This is the Circle of Competence podcast, hosted by Benton Moss and Neil O'Donnell. Warren Buffett made famous the Circle of Competence concept as it relates to business, referring to each person's knowledge and understanding of a particular industry, asset class, or company. In this podcast, we seek to distill timeless lessons from the best investors, founders, and operators in hopes of expanding your personal circle of competence with each episode. Thanks again for joining us on this journey of compounding knowledge. Alrighty, welcome to the Circle of Competence podcast. My name is Benton Moss, and my co-host, Neil O'Donnell. This is our first episode, so might be a little bit interesting today as we sort of work out some of the kinks, but we're excited to get started with the circleofcompetence.co podcast. So this is the first episode today titled, What is an Empty Building Worth? So we'll be discussing some questions around our investment philosophy. But before we get there, I just want to give a little bit of background about how Neil and I met. So Neil reached out to me through the circleofcompetence.co website. And so we've been talking for the last few weeks about, how we might team up with something around the theme of Circle of Competence. And we came up with the idea of a podcast. So Neil, why don't you talk a little bit about what we'd like to accomplish in the podcast?
Absolutely. So, and thanks, Benton. And I should also just note that circleofcompetence.co is a terrific resource. I've been following it for, the better part of this year, and I, really enjoy it. After following it for weeks and weeks, I was happy to link up with Benton. So what we're looking to get out of this podcast is Benton and I both follow and look at some of the best business operators, some of the best investors around the world. And we were talking about what we hope to do is to distill these timeless lessons from these operators and these investors, and to better ourselves, to make ourselves better investors, better business operators, and ultimately just better people. And so that's what we're looking for. And I'm really excited to continue to learn with Benton and to go from here.
I think the key to this that I want to impress upon the audience is that we are not coming from any specific points of expertise. While we are knowledgeable about a lot of the topics that we're going to talk about, we are exploring just as much as you are. And so we invite feedback, we invite comments, suggestions, and really conversation around some of the topics that we're interested in. And the whole idea of this podcast of Circle of Competence, this idea of Circle of Competence is education, right? Is enlarging your circle ever more. Just like the master himself, Buffett likes to talk about which is ultimately where the idea of Circle of Competence came from, which is to enlarge your circle of what you are competent and knowledgeable and educated on, so that when an opportunity comes your way, you can swing for the fences. So
absolutely right. I think that we're both constant learning machines, and hopefully we can find some other people out there that are on the same path. So
that's right. That's right. Well, let's jump right in. So today's episode is titled, "What is an Empty Building Worth?" And Neil and I put together a few resources that we read through this week. And one of the best quotes that we found in the resources that we were putting together for this episode was the following. It was a quote from one of Buffett's op-eds in, I believe it was Fortune. Was that correct, Neil?
It was in Fortune, and that it came from a shareholder letter, the 2010 shareholder letter.
That's right. It was reproduced, and this quote reads as following: "Whatever the chatter, in terms of market noise or price fluctuations or whatever economic noise, whatever the chatter, corn would keep growing in Nebraska, and students would flock to NYU." So I want to start right there, and Neil, I want to ask you a question. What does this tell you about Buffett's investment style? Just that one quote.
That's fast. It's a fascinating quote, right? And it really distills his core idea, which is, one of understanding and focusing on the key variables that really matter. So here, Buffett, as always, is looking to take advantage of Mr. Market. And Mr. Market really comprises all of us in our psychology, which can go from euphoria and thinking that, the market will go, continue to go ever higher, which is kind of what I think the market was doing until at least the last few weeks. And also on the flip side, can be very negative. It can be very, Mr. Market is a manic depressive. And what we need to do is to isolate and to look at the variables that really matter. So whatever the chatter, whether the market is euphoric or whether the market is very depressed, we need to focus on what is the intrinsic value of a business. And for businesses that are, and for shares that are really just pieces of businesses or stocks that are pieces of businesses, the key variables that really matter are just those of operations. For a farm, how much corn can it produce? Can it produce even more next year? How fertile is the land? And what's the replacement value of that asset? And for a building, specifically one leased to NYU, what are they paying in terms of square footage? Is that square footage expected to expand along with tuitions, for example? These are the variables that really matter, and everything else is just noise.
And I think to back up just for a second, so we're going to put these resources into the show notes. So I encourage you to read through some of these resources. But this one in particular, that was reproduced from one of Buffett's one of his shareholder letters, details two investments that he made. One was in a farm in north of Omaha, Nebraska, and one was in I believe it was a retail center. Just adjacent to NYU, New York University. So, and his whole point was that A, the farm would continue to produce corn, right, until kingdom come, and B, he was fairly certain that NYU's doors would be open and that students would continue to enroll there, and the tenants that would be in his building would benefit from that population. Right. So these big levers on these investments, he was pretty sure he knew how to pull them. He knew exactly how they worked. And this concept of the 6-inch hurdle versus the 7-foot hurdle. Right. He always talks about
Absolutely.
how he likes to have the 1-foot hurdles where he can just sort of step over it instead of have to, pole vault over it. And I think this is a good example of that. These two investments, he talks a lot about staying within your circle of competence too. And so, Neil, this is my next question that I wanted to discuss. Right. So
Right.
another one of the quotes from this article that we'll be sharing, it reads like this. It says, "It's vital, however, that we recognize the perimeter of our circle of competence and stay well inside of it. Even then, we will make some mistakes, both with stocks and businesses, but they will not be the disasters that occur, for example, when a long rising market induces purchases that are based on anticipated price behavior and a desire to be where the action is." Okay, so my question is, here it is. Here is the classic circle of competence theme that we're getting after right here, right? So
Right.
So how did he know that the farm and the real estate investments were good investments, despite stating in this article that he wasn't an expert in them, right? I want to dive into that.
Absolutely. Right. And so for both, it's very interesting to consider that he isn't an expert, that these might fall outside the circle of competence, or that he relied on other operators to buy these investments. But he still understood how the fundamentals of the business worked. Unlike a lot of other investors, including Stanley Druckenmiller, who purchased tech stocks, even though he later admitted that he knew that they were overvalued, Buffett never bought a technology company that he didn't fully understand. And as a matter of fact, the one technology company that he's bought before Apple was IBM, with very, let's say, decidedly mixed results.
Which he then subsequently sold.
Right, exactly. Yeah, it didn't have the moat that he initially anticipated. So looking at these companies where he doesn't have a knowledge of the day-to-day operations of either the farm or of the retail center, he still was going in with other operators. In one case, his son, Howard Buffett. In the other case, another operator that he purchased the assets with, Larry Silverstein, and who was an adjacent landlord for the property. And so he went in with an operator that he trusted, with a partner that he trusted, and he knew how the business worked. He knew how the money was made. He had a good forecast with regard to the expenses. And so as a result, he was able to predict what the business did, whether or not there was a moat, and whether that moat was likely to expand or to shrink in the coming years. And as a result of a knowledge of all the variables that matter, he was able to make an investment, and one which in both circumstances turned out to be an excellent returns, both in terms of the income generated and the capital appreciation to the properties purchased. So while he doesn't know every detail, and he might not be involved in the day-to-day operations of either, he's the consummate investor because of his knowledge and investing within that circle of competence described by his knowledge of how the businesses work.
I think that's spot on. Two things that I want to kind of hone in on are his prodigious use of good operators.
Right.
And I don't think it's any secret that Berkshire would not be what it is today without the solid operators that he's had in his companies, right?
Absolutely.
So I think the key there, right, is you have a good operator, a good manager of the property or the business, right? Which I think, honestly, I'd like to do an entire episode on how he incentivizes those men and women who he buys the businesses from, and sort of how he sort of keeps them aligned and incentivized and working in the right direction. And then the other piece that I remember seeing in this particular Fortune piece was that he was fairly certain that normalized earnings were going to be about 10% of his equity cost, right? So he's going to be earning about normalized, 10% return on equity. And I've seen that number in Buffett's writings crop up quite a bit, right?
Absolutely.
Like that double digit normalized unlevered return that he's looking for, right? And so he's not trying to, buy in the mid to high single digit yields and then lever it up. He's trying to get that double digit equity return, unlevered, so that when and if he wants to lever it up, and by the way, for those by leverage, I'm just referring to just simply borrowing against the property or against the business to sort of juice those equity returns. He can do it, right? So he has that margin of safety. So I think the two of the key things that you just talked about were having a great manager in place, and right. And then the point of buying when the price is right. So that sort of leads me to this next little question that I want to ask. And again, the title of the episode is "What is an empty building worth?" And we titled it this way because we wanted to discuss some of the best investors, namely Buffett, Howard Marks, and Seth Klarman, and actually in this episode, Ed Thorpe, who may be a little bit lesser known than the other three, but how they think about investments and right. their investing process. But which, by the way, all four of them are markedly different. So the reason we titled this episode "What is an empty building worth?" is because we wanted to sort of take a look at how each of these four investors might value this building that Buffett bought into, right?
Right.
So Neil, why don't you take a stab at that and talk about the other three and their perspectives, sort of what they've added to the value investing or just the general investing community in terms of their thoughts on this.
Absolutely. So I start first with Howard Marks, and he's framed this question within a number of shareholder letters, both in especially euphoric or ebullient times like 1999 and in 2008. He's brought up this question of what is an empty building worth, with the idea being that in times like 1999, when investors are especially excited and they can only see the stock market going higher, they'd see this empty building and they would just see it packed with tenants, and not just any sort of tenants, but high-paying tenants that would agree to high escalators in terms of square footage costs. That this building might even grow to the sky, right? That the potential is really limitless and untapped at present. In the flip side, in 2008, the same investors in a much more depressed environment might see this building not as an asset, but as a liability. And that's because it would never get filled and it would have to get knocked down. And so as a result, there wouldn't be any sort of recurring revenues associated with this building, no future leases. But in fact, a business that just couldn't cover any sort of debt that was placed on the building, and in fact would have to be knocked down. So for Howard Marks, his view of this is an empty building is worth the value of its cash flows discounted, which is true for also Buffett and Klarman. But what Howard Marks really brings to this equation is, one, giving us the name for the episode, which we appreciate. Thank you, Howard, if you're listening.
Right.
Of course, that would be a big deal. And then second, and even more important, he gives us this perspective of investor psychology, that without any sort of immediate cash flows, it's very tough for the investing community to gauge what is this asset actually worth, and does it have any value or does it even have a negative value? So I think that from Howard Marks' perspective, what he tries to do is not only to just look at this building, but then also look at the entire capital structure. Howard Marks is a famed investor, but unlike Buffett and Klarman, has actually had much more success in the debt space, especially the high yield and distressed debt space, than the equity space, even though he has an emerging equity fund as part of Oak Tree, his investment firm. But so I think the other thing that Howard Marks can appreciate within the building is what is an empty building worth, but what is the entire capital structure worth. So if we carve that building into a mortgage on the building or a ground lease for the land underneath the building, that might be assigned a lower discount rate because it's lower risk. Conversely, the equity interest, especially upon being levered, is higher risk. It's only the residual claim after the mortgage is paid. And so from the Howard Marks perspective, another thing that he could bring to this is to look at the different pockets of financing, be it equity or high yield debt, which is typically in between equity and senior debt, and then finally senior debt, and to be able to carve this building up into the different parts of the capital structure it represents. Do you want to take it from here? Do anything to add on that?
What I was going to say too is Klarman likes to make the distinction between investing and speculation.
Right.
And you made a good point about Marx's his theories of investor psychology and sort of the market cycles, which, by the way, our second episode is going to be on market cycles. So we're going to kind of dive into this topic a little bit more. But his ideas about the market cycle and investor psychology, what I would say range between, again, fear and greed, right?
Right.
Or optimism and pessimism. Sort of the two sides of the continuum, right? So how do you think about somewhere in between? How do you think about investing versus speculation? Because Klarman likes to talk about this dichotomy of investing versus speculation, right? He says that investing is basing it off of future cash flows, while speculating is essentially betting on future price appreciation, or if you're betting against something, price depreciation, right?
Absolutely.
So it's betting on price action, right? So my question is kind of this second level thinking that Howard Marks likes to talk about is when we're quote unquote investing, right? Basing our expectations off of future cash flows, right?
Right.
How do we delineate between investing versus speculating on future cash flow, right? Because anybody can do a DCF or discounted cash flow analysis, but how do we normalize those earnings, as Buffett would say, right? So that's my question is you could almost be speculating if you have an over rosy, over optimistic picture of what the future cash flows are going to be. Am I making sense? Does that make sense?
I think that entirely makes sense. And I think that's an excellent question. And I think that Klarman's definition of investing versus speculation is probably narrower than some other economists and other theorists. John Kenneth Galbraith, for example, said that speculation is a bet with knowledge of the risks, and speculation, and whereas investing is a bet without the knowledge of those same risks. So different, intelligent minds disagree on really what constitutes investing versus speculation. And John Kenneth Galbraith is more of a joke regarding the investment community. But for Klarman, the idea of investing on near-term on cash flows is an important one, and one that he finds is critical for any value-based investor. And so what Klarman's idea is based on cash flows. And in this situation, I mean, it should be pretty clear that if we define it as existing cash flows, we'd be speculating, right? This empty building isn't filled with any tenants currently, which is really what Howard Marks' idea regarding the market cycle and investor psychology preys on or gets to. For Klarman, if we're looking at a building in a good location, I still think that we could fall within the value-based investing idea by virtue of the fact
replacement cost, perhaps,
exactly.
Right? Maybe not a discounted cash flow analysis because there really is no cash flow, but from a replacement, what would it cost to build a building in this location right beside it right now? Precisely,
right. And we could also tool around with our assumptions to say, well, what are comparable buildings paying in the area? And maybe that's $50 a square foot, for example. And so for Klarman, Klarman wrote a book, Margin of Safety. It's an excellent book. And that's where he discusses investing versus speculation. For Klarman, I think that we would take those assumptions and put in a margin of safety. So if we were only getting $40 per square foot and only 80% of the building was in fact rented, we can look at that as an idea of the future cash flows of the building, and we can discount those expected future cash flows, which again include two margins of safety. This isn't a building that's going to make $60 a square foot or $100 a square foot, and it's not a building that's going to have 100% occupancy. So, to paraphrase, another brilliant value investor, Ben Graham, I would rather be imprecisely right than precisely wrong. And I think that Klarman's idea of investing versus speculation is one that carries through this idea of, as you talked about, tacking to replacement cost or another key feature of the asset. For example, maybe there is a license for this building or something else which has an intrinsic value and an embedded value that we can harvest. And two, we should be looking at the discounted cash flows of this business. And those cash flows should be the cash on cash returns. It shouldn't be a situation where we're saying, well, we'll make $100,000 on this building for 2 years, and then we're going to sell it for 2x what we bought it at, because that would again be looking at capital appreciation, not cash on cash return, which is inherently a part of a speculative model. You can put a lot of speculative things into a DCF and make it look, very appetizing. But for Klarman, all of those things he would not classify as investing.
Right, and I'll back you up on that from a real estate perspective. Okay, so I'm assuming no one knows this, but I'm actually a real estate broker. I'm a broker's license in North Carolina, and so I look at a lot of commercial properties in the self-storage and multifamily space, and it's absurd what some of these brokers are putting into their models, right? Some of them will model out, hey, if you buy it at the purchase price that I have it listed, lever it up, 4-to-1 debt to equity, and, you ratchet up the rents at 2% a year. And then, oh, by the way, you somehow magically grow the margins by 10%. Well, then you're going to get a 25% IRR, right? So,
right? Like under
exactly, right? Yeah. So that's kind of what I'm getting at. As astute investors, we have to be able to cut through the dross, right, and get down to what is the normalized earnings of this property or this business, right? Which is extremely tough to do. I mean, it takes a career to do that. And I think where Marx comes into this is from the psychological aspect. When you have one of these deals in place, you get excited, your heart kind of quickens, your blood pressure goes up, your heart, starts to race, and wow, I could make 25% IRR if I hold this for 10 years and sell it and do this and pay down the debt like that. But I think that it's coming from a psychological perspective, you have to calm yourself down, right, and ask yourself, what are the normalized cash flows on this, right? Because just like you just said, you can't count on just random price appreciation because that's how it's been, the last few years. You have to sort of value it based on what the cash flows reasonably will be in the long term, right?
Precisely.
So
right.
I think that's a great point.
And whenever you have a doubt regarding a range of values, to be on the lower end, right? Just to be conservative within the set of estimates.
Right. Well, I want to move on to the last couple of questions that we have, but I want to read this quote from the article, the Fortune article, another quote that I found particularly interesting, and I want to ask a question around it for you, Neil. So, forming macro opinions or listening to the macro or market predictions of others is a waste of time. Indeed, it is dangerous because it may blur your vision of the facts that are truly important. When I hear TV commentators glibly opine on what the market will do next, I'm reminded of Mickey Mantle's scathing comment, "You don't know how easy this game is until you get into that broadcasting booth." So I had to laugh at this one, right? Because
it's such a great quote.
It's just a great quote. It's a great quote. So my question is, how do we square this mantra of, as Buffett always loves to, is keen to say, he didn't really care whether we're in a zero interest rate policy or if we're in a 10% interest rate policy, right? Like, he's looking at what are the real returns for his shareholders going to be for every deal or every stock that he purchases. Right. So that's interesting. I wanted to discuss that and kind of how do we square this idea with sort of the fact that we're in this zero interest rate policy. They're starting to tighten. Interest rates are starting to rise after several years of being completely flat and completely artificially depressed, right? So don't you think implicitly, Buffett and Munger understand where we are in the macroeconomic cycle?
Right. I mean, I think that Buffett and Munger are always wary of where we stand in the cycle, just like Howard Marks always thinks about where we currently stand in the macroeconomic cycle. I think the difference between Buffett and Munger and someone like Stanley Druckenmiller is that they don't try to make predictions as to where the cycle is headed. I think that Buffett and Munger take the cycle as it is. They're probably mindful that we're in a macroeconomic expansion, and we have been for some time, which has been in large part fueled by the zero interest rate policy of the Federal Reserve and the negative interest rate policies of Japan, for example, or Germany until recently. So I think that Buffett and Munger are mindful of macroeconomic data. And if you look at in 1999, when Buffett was out of favor, he did a speech in Sun Valley where he talked about interest rates serving as basically gravitational pull for asset prices. As you turn up interest rates in the 10% environment, or even higher, as Buffett saw in the very early 1980s and the late 1970s, when interest rates exceeded 10% and for a point we're at 16%, that was a tremendous pull downward for asset prices. When in 1982, the Fed started to decrease those rates, the result was that asset prices expanded forward. So I think that Buffett is mindful of that and mindful of how low interest rates are. But I think that the difference is that Buffett isn't looking at the opportunity cost of capital being a zero interest rate or the interest rate plus 3%. Buffett always considers his cost of capital to be the cost of the next best opportunity. So for Buffett, if he could buy another See's candy and that would generate, today's prices, a 12% IRR, or he can, reinvest in his existing operations at a 10% IRR by, for example, expanding Mid-American Energy and continuing to grow that business. That's really what he would benchmark against. So he's not benchmarking against the current interest rates, but rather his own opportunity set, and then deploying assets to where he feels they'll get the highest and the best use of capital and the highest long-term returns.
Yeah, no, that's good. I think implicitly that they're not keeping their eye on the scoreboard of, whoa, where's the 10-year right now? How's the yield curve looking?
Right. Where's gold? Right, all these things.
Right. And I think you made a really good point about the fact that they don't care about that because they're not making directional bets on whether the yield curve is steepening or if credit spreads are tightening, right? And how the macroeconomic environment is going to change in the next 6 months, 12 months, 2 years, right? They're not making directional bets on that. I also think this plays into the fact of the fact that Buffett and Munger don't like to invest in businesses with a ton of debt on them for that reason. Right? When people fall, when economies fall on bad times, as he's so fond of saying, you only find out who's swimming naked when the tide goes out. Right. And so he doesn't want to buy those companies that are swimming naked, sort of feasting off this cheap debt. Right. And so I think that's a big part of it too. Benton Neil actually has made this point several times in his private equity fund that they love to underlever a lot of their companies because and he loves some of the cyclical companies that can make a ton of money on economic upswings and lose maybe just even a tiny bit of money during a downswing. And they'll underlever them so that in the bad times, they can hunker down and they'll be just fine and come right through it. Whereas, traditional private equity buyer or even sometimes corporate acquisitions are just debt laden and, they fall in hard times and things happen. Right.
That's exactly right.
Badly timed. And so I think that's one of the reasons why they don't like to take on a ton of debt when making acquisitions or acquire companies that have a ton of debt already on the balance sheet.
I think that's an incredibly smart point. And one other thing I would just add on that is Buffett and Brent Beshore are also less likely to take on businesses with substantial operating leverage. So what that means for everyone is that for business with operating leverage, consider a factory that it's just a fixed cost in the ground. And it creates, if you have 100 units in it, it will create $10 of profit. But if we put through 1,000 units, it can create $100 of profit with no incremental capital spend. So with limited operating leverage, it can function a lot like debt. Just like debt can amplify losses and gains, operating leverage does the same. And one thing that Brent Beshore has talked about, to your point, is that he also looks for businesses that are cyclical, and he won't try to grab the most market share, because a lot of times that additional market share comes at the expense of being more operationally leveraged. And so as a result, if you take on every piece of work within the space, especially a space like construction, for example, there can be a huge drawdown where now you own a lot of equipment and that equipment is sitting idle and you're losing money, or you're not getting a return on the money that you've put into the business. And so as a result, I think that's a brilliant point, Benton. And it's another thing where Buffett and Brent Beshore and Munger are all insulated against these economic winds and can care less about them because they're taking prudent measures throughout the entire cycle.
Yeah, I think that was one of my more pressing questions as we read through some of these resources that we'll share in the show notes, of how do we square this mantra of not really caring about the macroeconomic environment to how do you sort of know where we're at in the macro cycle and understand the times so that we can better position ourselves in our investment portfolios, be it in real estate and private companies or just plain vanilla equities, right? So my last sort of point and question here will be a question for the audience, but I want to point out that that I like to think of this example of Buffett buying this farm and buying this empty retail building as sort of a mental model, right? This mental model of what is an empty building worth, where we talked a lot about replacement value, about investing on based on future cash flows versus just anticipated price appreciation. And so I want to point out that Buffett made a great investment earlier in his career, in his partnership years, I believe, in American Express. And I want to sort of apply this mental model of a potentially empty building. Right. So right. If you guys have studied this at all, you'll remember that that American Express was on the hook for potentially millions and millions of dollars of warehouse receipts for salad oil that was never actually there because of this obscure warehousing business that they had. Right. And so their stock price got crushed. I mean, just absolutely crushed. And Buffett scooped it up. It's at one point, Neil, I don't know, you probably have the figure, but I think it was something like 40% of his partnership was into this stock. That's precisely because everybody thought that this was going to be a quote unquote empty building. Like this company was going to go bankrupt. It wasn't going to be worth anything. And yet he knew exactly what, or he had a good idea at least that, this too shall pass and what the normalized earnings would be going forward because they had such a strong brand, right? Exactly. So I think this mental model of what is an empty building worth, and understanding normalized earnings of a potential property or a business it can be used in a lot of different scenarios. So my question for the audience that I want to leave you guys with is, and I'd love to hear feedback and maybe in the comments or via email, is there a stock or a business out there that you think fits this empty building mental model? Right? Why or why not? And sort of what's your thesis around why you believe that the market is missing something that you may have?
Excellent. Yeah, I think that's fascinating. And that's a great application of the mental model. That's great.
Well, let's wrap up here. Thanks you guys for listening. We'll be back next week with our next episode on market cycles. We'll see you then. Thanks again for joining us on this week's episode of the Circle of Competence podcast. We always appreciate feedback on our work and consider your referral of the podcast to family and friends as the highest compliment. Don't forget to subscribe to the weekly newsletter at circleofcompetence.co. That's circleofcompetence.co. And we look forward to having you back again with us next week.